It's an obvious place to start. We've all talked about how much dry powder there is. There's been much speculation about where it gets spent, how it gets deployed, about $800 billion going into 2020. What opportunities does it create for the private equity industry?
Well, thanks for having me, Ed.
Thank you for being here.
Before I specifically answer your question, I just want to say that the industry itself is extremely healthy at the moment. As you said, robust fundraising environment. There's also tremendous returns, outside returns, and the capital markets are wide open. But in terms of how our clients are looking at this environment, a couple of things. One is they're looking for opportunities to do larger deals. And if you actually look at the deals done in 2019, there were more deals done that were $10 billion and over this year than any year in the history of private equity. If you look at the average of probably the last 5 years, 16% of the deals were $10 billion and over. This year it was 23%.
Well, on that, how big can they go? Because look, we've obviously all been talking as well about the potential Walgreens KKR deal, which would be one of the biggest, if not the biggest LBO in history. You talk to a lot of the clients that are looking at these deals. What are we talking about in terms of numbers?
Well, I don't want to speculate on any market rumors and talk about any specific deals. But we all are talking about how large a deal can get done. And I can tell you that our clients are looking to put large amounts of capital to work. So we at Goldman Sachs are looking through our industry teams as well as around the globe at large transactions. And we've thought about how large an equity check could a private equity firm write, because that's really where the constraint is, not in the debt capital markets. And when we think about what a fund can contribute, what their LPs can contribute alongside of them, and perhaps a preferred equity layer, we're thinking $10 to $15 billion is doable. So the question is how large a deal can get done with that. Can you do a $30 billion deal? Yes. Could you do an $80 billion deal with that? Maybe, if you have a strategic partner as well.
And a very willing one. So look, on that point, we've seen a lot of deals get done, big deals get done with higher equity than we're used to seeing. I think it's close to about 50% in deals this year. What does that tell us about the way sponsors are approaching some of the bigger transactions they're going after?
Well, you're right, Ed. This year, the average equity in private equity transactions is 46%, which is a very large percentage. What we have seen is that our clients are doing a lot of work in advance of companies coming to market, so that they're ready and prepared. But also in order to preempt a process, in order to be very quick in a process, they want to put a lot of equity in so that they have assurance that the transaction will get financed. So we are seeing more equity. We're even seeing in very, very large deals. Where, you know, there's an $11 billion deal that H&F drove this year, and in a software company, and they put $8 billion of equity in, so it was like 70% equity. So we're seeing very, very well capitalized transactions.
What does that do to return profiles? Because presumably if you don't sort of lever it up as much, it's much harder to generate the same return that you would expect.
Yeah. Well, we're not seeing any difference in expectations from our large private equity firms in terms of what they're looking for. They're still looking for mid-20s rates of return in their traditional buyout funds. So when they find a company they like, it could be a high growth company, they might be looking to buy and build. They might be looking to put it together with another company that they own. So the returns that they're driving to are no different than they have been in the past. They might just get there differently.
So that's the front foot approach. Obviously, the sort of sponsors being real creative. We've seen this buy and build strategy the last couple of years, big deals getting done. What about on the downside risk? Because there is a lot more, I suppose, noise that there's potentially an economic downturn on the way. We have the election next year, various other geopolitical headwinds. What are the sponsors doing to be ready for that outcome?
Well, it's interesting you ask that, because every one of our clients is focused on being prepared for a recession. And there's a different level of preparedness depending on their macro view. So on the one hand, we have clients who are just looking at their capital structures and saying, let me make sure that all of my capital structures are ready in case there is a recession next year, and my 2-year plan has to be a 4-year plan, or my 3-year plan has to be my 5-year plan. All the way to the other side where I've seen clients who, in fact, I was in Asia earlier this fall, and I saw the head of a private equity firm that has assets all over the world, and he said he had given a recession checklist to each one of his CEOs with 9 things on that checklist that he wanted all of them to work on and come back to him. I actually asked him what was on that checklist, and he said things you would expect, like talking to all of their suppliers and asking for extension of terms, or only doing capital expenditures that had to be done, only hiring people that were essential. So our clients, from one end of the spectrum to the other, all of them have different portfolios, some more or less recession resistant. So depending on their portfolios and their view on the macro, they're thinking about one end or the other, but everyone is really focused on it. I'll say Goldman is more optimistic than the consensus. I think the consensus estimate is 33% recession in the United States in 2020, and I think we're closer to 20%.
You mentioned Asia in there, which is obviously a hugely important area for a lot of sponsors, and we've heard from some of the leaders of the biggest private equity firms that Asia is actually the most important market for them outside the US. What's going on there in terms of trends? Because I know you focus a lot on Japan and particularly on the opportunities that are being created for private equity there.
Well, in Asia generally, let me just back up a minute. If you look at GDP growth in Asia, however you cut it, whether it's all of Asia, Asia, emerging Asia, the GDP growth is still significantly greater than we see in the United States or in Europe. So our global private equity firms who are investing around the world see that as well. So there's a lot of focus on Asia. Now, Japan specifically, we've seen a lot of focus in the last 18 months. And one trend we're seeing there is for simplification. And if you look at the Nikkei 400, over a quarter of those companies still have 100 or more subsidiaries. And if you look at how the Japanese companies trade, the companies with the higher PEs have fewer subsidiaries. So the private equity community looks at that and says, there could be buying opportunities here in Japan. There's also, we look at CEO pay in Japan, and if you look at the average CEO pay, only 20% of it in Japan is long-term performance-oriented. And compare that to the US, it's 70% of our CEO pay on average is long-term performance-oriented. So we hope and expect that in Japan, the CEO pay will be more performance-oriented longer term as well, and that will lead to more M&A.
And that is a significant amount of simplification to be done there. So let's just wrap on this. Data is obviously a huge issue in all corporate spaces at the moment. In private equity, where you have these enormous portfolios of companies, sometimes running into the hundreds, that just seems like a massive opportunity set. What are the sponsors doing to harness it?
Yeah, it is a real opportunity. I mean, Warburg Pincus has over 185 portfolio companies, candidly. And I don't really think that any of the private equity firms has figured out how to capture all of that data to make better investment decisions. But they're all thinking about it. KKR just hired a head of innovation and technology, and part of her job is going to be to figure out how to do that moving forward. And I think over the next 5, 10 years, that's a trend you're going to see in the private equity world.